Well, I won't. Good morning, everybody. I won't waste any time waiting for people to come because it's a fairly short slot and we're starting 4 minutes late. Let me run through the presentation that I have here, and it'll be fairly quick because I want to give people time for questions at the end. The overview of the company is we have an existing project portfolio which is mining and minerals, and those are our sort of legacy assets. We actually started life 10 years ago investing in iron ore and manganese, and we still have some things which we haven't disposed of from that. We also went into gold, and we have some assets, exploration assets there. We have a model of exploring things as far as we can and then seeking partners or farm-ins or sales. But in the market of the last few years, it hasn't been easy to make those disposals, so that digestive system has not worked quite so well. And our feeling is that the bad times for the mineral sector may continue a while. It won't truly be over until there have been one or two very substantial casualties, probably. You've already seen a metal like nickel go down to its long-term pre-2003 trend. Copper seems to be heading the same way, which implies another 30% downside. Iron ore certainly has downside because the supply-demand situation has really ceased to be tight in these metals, so you must expect them to go back to their long-term trend. That means that it's going to remain a difficult environment for companies that restrict themselves to the exploration model, because the AIM exploration model typically has been to explore, then to raise money to do something yourself or find a bigger partner. That pipeline doesn't work so well now. So what we've done is we've more or less put those assets on one side, said we'll preserve value there, take value where we can find it, and we'll focus on near-term cash generation, because then we become a self-sufficient entity, not dependent on the market. We have just announced the first of those transactions, as you know. So we're saying that the historical mineral exploration business model is broken. I think to some extent the historic AIM funding model is broken, and so we're looking for cash generative assets available at reasonable prices. And there are plenty of them available. So we're moving in the direction from minerals to oil and gas, from exploration cash outflows to production cash inflows. Because once we decide we're looking at revenues, we're more or less forced to the oil and gas sector, because you can't subdivide interest in mineral projects at all easily. You can, and in fact, people always have subdivided interests in oil and gas projects. One of the first things I remember is the North Sea oil boom, and there were lots of minnow companies there, farming in and farming out to 2.5% or 1.25% or 5% interests. In Texas, this business has been going on for a long time. So you can have an independent, direct interest in a producing well or in an exploration project in the oil and gas field, which means that a small company can have a proportionate interest in something without having 100% of the overhead cost from owning an asset itself. So this pivot towards production has been combined with significant cost reductions. We have reduced ourselves to the position where we have 3 people who are running 2 companies. And that's it. And we're renting out space, and we're going to rent out virtually all of our space. So we're going to cut our cash outflows down to as low as we can possibly get them. And that isn't going to be a temporary expedient, but even as we grow the revenue model, we are not going to say, well, that's a relief, we've now got revenues coming in, we can increase our costs again. We're going to stick to a very disciplined approach, because whereas with exploration, you never really know whether you're spending too much or not. until you discover something. The average cost of finding an ounce of gold, for example, worldwide is about $30. We reckoned we were doing it for about $10 in Kenya per ounce. But in the effort to reach those targets, to reach those milestones, you spend the money that's necessary, and that's the way you think of it. When you're looking at buying a cash-generative asset, you do very precise spreadsheet calculations, and you look at the discounted cash flow, the internal rate of return, and you look at the sensitivity, for example, to a movement from $40 to $30 a barrel oil. So it is just like running a corner shop. It is very expense sensitive. So this repeats what I told you before. We're going to retain the existing project portfolio insofar as it's cost effective to do so, because we can work all of these assets rather than throwing them away and extract value from them, as we did from our gold asset in Colombia. We expect to be in a position to do the same with our gold asset, for example, in Kenya. Now, we made our first oil and gas exploration investment in Shotes Creek, which is onshore Louisiana, just by the Texas border. And this is in a relatively shallow horizon called the Frio, which has got enough pressure in it to be producing oil, but it has quite a lot of water in the mix. So one of the key things there is you have to have saltwater disposal wells available. But because it's relatively shallow, relatively cheap to develop, because it's a horizon that's been historically fairly neglected, actually we can look at it and there's very low geological risk. We know that these wells produce. The reason why sometimes they haven't produced is because people didn't have saltwater disposal available. Now, Northcote have drilled one well with their partners there, the LM20. It was extremely successful, has been approved for production, and is beginning to produce. And they expect something like 250 barrels a day from it initially, which is the permit they have. Now, the modeling of this shows a sharp decrease in production in year one, and then a decrease in year two, and then a sort of 15% a year reduction afterwards. But the historic results from one or two nearby wells shows that, in fact, one may be able to do much better than that. One may have a slower drop-off. But what we have done is all our internal modeling has taken that base case with very sharp drop-offs in years 1 and 2, because we wanted to make sure that the investment worked on that basis. Now, as step-outs from that LM20, there's going to be LM21 and LM22, which are the two wells that we are investing in. And the cost of LM20 was about $1.2 million. The expectation is we can drill those next wells for $1 million, partly because costs have come down, partly because of the efficiencies of having something there already. And we have 20% of that cost. We also have to invest in tank facilities and other things there. So what Northcote has said is that the LM21 will probably start drilling very early next year. It could be this year, but that's totally weather dependent. So no one wants to give a hostage to fortune by over-promising. And the other one will be in the first quarter of next year. So there is a possibility that you could have 3 wells producing, of which we'd have at this stage an interest in 2, which one might be looking at 200, 250 barrels a day production from each one, and we would have 20% of that. And profitability very high, because the operating costs of these wells very low. So it really still gives us a very good return, even if the price goes to $30 oil, or even lower. Here's a brief history of Shotes Creek. That is actually in our announcement that we made yesterday and was in the original announcement in October. As you see, there's additional secondary recovery options, and there's a possibility also of going into other wells in the field. I should say that, the LM20, which Northcote have, they have and other people have maybe slightly more of that than they want to, there is a possibility we'll back into that one as well, which will give us instant cash flow. But we're still discussing that. This is the Shoats Creek economics on one of our models. And you see we think we get a very good payback. If the first year and second year production really hold up, as some of the previous nearby wells indicate, then that payback is going to be faster than indicated here. But again, this is done on the basis of about $40 oil, and the oil price could come down. So we feel there's a lot of scope for deviation from the base case, and this still is a good project. Here's a map of the area showing other nearby producers and cumulative production. And this is a map of Shoats Creek, and you can see that on the left there is the Texas border. And so you've got East Texas, this immensely prolific, historic oil-producing area just along to the west. And the Frio horizon stretches from that part of Texas through Louisiana in a sort of band west to east parallel with the coast. Jupiter Mines, now we come to our historic assets. Jupiter Mines, this steel feed company that we have an interest in that we took private, has been more than 11% of the Chinese manganese imports. It's maybe the cheapest producer in the world. We've been ahead of the curve at Jupiter with our colleagues there, and we've reduced costs faster than anyone else. And so we were thinking that $2.20 per dry metric ton unit was about the lowest we could produce at, but actually for next year we're looking at about $1.45 per DMTU. So this is why, people who tell you that mineral prices can't go down because the break-even cost is X or Y, believe me, because I've seen it from the inside, the production cost keeps on coming down and down and down when you're in a bear market like this. And so you may have seen that that steel company in the UK telling its suppliers they had to reduce all their everything they supply by 10% immediately in cost and by 30% over a period, or they'd stop dealing with them. Well, this is what happens. When you're selling commodities, you take the price in the market. You're a price taker, not a price maker. When that price goes down, you have to start squeezing your supply chain. And as you get further from the market price, people are more and more resistant to reducing, say, the rates if they're geologists they charge out at, to reducing the price they sell machinery at. So that squeeze really has to take place, and while it's taking place, there's that bunching of costs. You're selling for less, you haven't reduced your costs yet, so everyone becomes a little unprofitable maybe for a while. And even if you're the cheapest producer, you can go through a few months of that. But eventually, these cost reductions drive through the system. The important thing is to be ahead of the curve, not behind it, and then things are restored, and the cheapest producers really make money because a lot of the other people have been wiped out. So Jupiter Mines is an extremely valuable asset. It's in our books at about $2.8 million. The attributable NAV in the Jupiter that's attributable to the cash owed to them by the mine and from the profits from the operations of the mine, that is equivalent to about $5.5 million on a see-through basis to us. So when the market stabilizes, eventually, that's going to be a very strong asset with a 50, 60-year life, and more than justifies our market value, I'd say, on its own. Although, if you are selling it, today is definitely not the day you'd be wanting to do that. Ivory Coast Gold, we have exploration. We've told the story about exploration in the Ivory Coast, and I think that as we proceed with getting the grants of the applications there, and there's no particular reason for us to hurry, because we're not anxious to start spending a great deal of money there. We want to enter into farm-ins and joint ventures with people who are working with us, because this is one of the most attractive areas. So that's what I mean, is we're retaining assets in the mineral sector, but what we want to do is we want to work them, and we don't want to have, keep the upside without having the cost, because raising money in this market is something that's going to be expensive for us. That's a bit more about those assets. We're not going to neglect them. We are going to proceed them, but this is not the most important thing for us. The most important thing for us at the moment is getting to cash flow positive through producing oil assets. Once we've done that, we can accelerate some of these other parts of the business again. Elephant oil in Benin, onshore. It's an extension of northern Nigeria. It hasn't been explored. It's tremendously good geology. A geologist from another company that's been looking at West Africa actually got in touch with us and said, who we know well, and said, you've got some really good ground you have an interest in there. I think Elephant Oil has not added the other assets and got the listing that they were expecting and hoping to do, but still it's a good team there, a good operations guy in Matt Lofgren and a good market guy in Gavin Bonnell, and they are working on this to give this liquidity and to put it into some strong hands. So we think we're going to be okay there. That's the asset. It's a fantastic onshore position covering multiple targets, and it contains a lot of oil. This is the Dahomey embayment. As you know, there's been quite a lot of activity just offshore there, and the fattest part of that embayment is where this license is. In Kenya, if we've been waiting for licenses to be granted in Ivory Coast, we've actually been waiting on the court system in Kenya, and we knew that there was mischief afoot a year or two ago, but until they actually came out and tried to do something to our local partner, we couldn't take the obvious action, which is go to the court. And so far, we went to the court for a stay of what they were planning and for injunctions. And the government side has had 3 deadlines to put in some submissions. They failed to do so. They turned up in court and we were asking for judgment on the scheduled day, having put in all our affidavits, all our pleadings, everything, and there's still nothing from the government, so they asked for more time. Truth is, they're not going to be able to make an argument, and they're not going to be able to answer our points. They don't have a case, and our lawyers are very confident that we're going to be given those licenses back. The smart move by us is to try to come to some compromise before that happens. And we did receive an approach from the ministry saying they'd like to sit down and have a compromise, but could we abandon the legal proceedings first, which is a bit like having a negotiation with a tiger who says, well, I'll negotiate with you as long as you put your rifle down first. You really wouldn't want to do that. Now, the Cabinet Secretary for Mining has not just upset us, but a lot of other companies in Kenya for much the same reasons. He has just gone. He's gone off to become Secretary for Tourism, and we have a new guy and a new era. So we don't think our 1.2 million ounces there is locked in and valueless. We, in fact, used what's been happening over the last year to up our stake in these assets to 75%. And we consider that somehow we're going to be able to work this asset to extract value from it. Yeah. Okay, I see I had 19 minutes, so I will end up immediately now and skip Star Striker, Regency Mines. We have investments there. We have over $1 million in Star Striker. These things are sources of liquidity, and if anyone asks how are we going to be able to fund the investment in the oil and gas drilling, that last slide gives you some of your answer. So thank you very much for your time. There is no time for questions, but I kept within the 20 minutes, so thanks.